Welcome to the CEO Project Podcast, where Jim Schlexer, author of the best-selling book, Great CEOs Are Lazy, and the founder of the CEO Project, provides ideas and tools to help CEOs of mid to large-sized companies grow and optimize their businesses. Now, let's get started with the show. Welcome, everybody, to the CEO Project Podcast. My name is Jim Schlexer. I am your host and the founder of the CEO Project. So we work with middle market CEOs, sort of 20 million up to as much as $2.5 billion. And one of the key members of their team is the CFO. And the difference between a controller and a CFO is a controller calls balls and strikes, right? They tell you what happened, and that's really about it. As we move to a CFO, you expect interpretation as well as forecasting. Well, it turns out that there are very smart tools that can augment the performance of your financial team. And our guest today is an expert on this. She founded a company in the space, Oana Labes with Financiero. She is a business financial planner, strategist, and coach. She's helped hundreds of companies scale 10, 20x, advise CEOs and CFOs of decisions like $20 million commercial financing deals, M&A transactions, expansions, and has personally managed over $300 million of commercial finance deals. So she is truly an expert in the space, and she's going to drop some knowledge bombs on us today. Welcome.
Thank you for having me, Jim. It's a pleasure to be here.
We're so glad to have you. Thank you for taking the time. That question of is CFO controller, you probably bump into all the time. How did you get into this space of, with a software-driven product, a SaaS-based product, helping people do these analysis, do this forward looking? How'd you get to this place? It's not something you grew up as a young child and said, oh my gosh, I want to be a finance person, or maybe you did.
Well, funny enough, I actually grew up across the world in Romania, and I was an entrepreneur before I relocated to Canada about 15 years ago. And no, I didn't grow up anything finance related. In fact, funny enough, I used to be in my mid 20s when I started actually early 20s when I started my first company. I used to be one of those entrepreneurs that could not figure out why they were profitable and never had any cash in the bank, right? So that's actually my humble beginning. And to think that today I'm a CPA MBA that has built, what we believe is best in class CFO brain technology that can live with any one of our clients in a way that makes their controllers and their CFOs highly empowered and enabled if they're there, but in a way that doesn't leave the company exposed with a single, point of failure if those roles are in transition, if they're shuffling their finance teams. And I've dealt with this as a commercial and senior commercial lender for over a decade, where the output from mid-market companies, and by the time I left that role, I was managing one of the largest portfolios in my region in Ontario. Mm-hmm. All of the output was fundamentally disconnected from what the company was trying to accomplish. They were trying to scale by the tune of a $17 million financing transaction, and they were showing up with a one-year P&L and profit and loss statement or a forecast, and a very disparate, disjointed historical picture. It was so hard to put together that by the time you were done figuring one out, you had missed out. As I was sharing earlier, you had missed out on 10 of them. So many companies that did not show up prepared. So really my story is having dealt with that for a decade and then starting the company that is hopefully going to empower hundreds of other companies, not have to depend on the CFO intelligence. And if they have a CFO role staffed, maximize the output and the potential of that individual.
Yeah, that's great. And the problem is a lot of CEOs don't even know the right questions to ask. They're really dependent on the CFO to give them the information and explain things to them. And if they're a finance-oriented person, maybe they've got the right questions, but, bunches of CEOs are not, they're marketing or engineering or whatever. So how do you help a CEO make the decisions they need to drive their business forward and grow it without running out of cash, which is obviously the big boo-boo you don't want to run into? So how do you help them think about that? How do you help them understand that?
Well, it's such a great question, because coming back to Financiero, when I founded this company, I was telling myself, this is going to be the CFO brain that will live in each of the companies. It will take all of their financial data. It will output intelligence, not reports, not ratios. Nobody has any use for those unless they tell you what to do next. I want you to tell me the future. Here's everything I have. This is sort of how we imagined it. Yeah. So, raw input data, output comes financial intelligence. But then it occurred to me that this dynamic between the CEO and the CFO was another problem I had to face and solve. It's great if you have financial intelligence, but if the CEO doesn't know how to use it, then it's just going to live in pretty dashboards in Power BI, which is what we ultimately output. So what I started as well is a CEO coaching program, a live 6-week coaching program where I effectively teach them at the CEO level, not the CFO level. I'm a CPA and I'm an MBA, and I've worked with CEOs for, the better part of the past 15 years. So I know exactly the kind of information needs they have and how to tailor information to their decision-making requirements. So I started this program so that ultimately I would teach them how to engage with their CFOs, how to engage with their boards, their lenders, what questions to ask, and very importantly, what assumptions to question. Because it's ultimately not up to them to figure out how to forecast, but it's very much up to them to understand what assumptions have been built by the finance team, by us, if we're the CFO brain, helping put that and automate that into their enterprises, and then be in a position to say that assumption no longer holds. I can no longer back that up. I need a different set of assumptions.
When I was doing budgeting, I actually started with the assumptions. Margin's going to do this, revenue will do that. The budget fell out of the assumptions, right? So that's where all the action is. And even more as we went through the year, whether we were making or not making, it was all tied to the assumptions, right? That assumption was right. Okay, that's tracking. That assumption was wrong. That's not tracking. And so I think you're right in terms of going to assumptions. When you're working with CEOs, what are their blind spots that you see most commonly? What are the places where we go, we're not thinking about these 2 or 3 things, and we should be in a very big way. What have you found?
Well, the biggest thing, which is why I started the program, the coaching program, is they tend to work out their business strategy in a vacuum and then hand over the plan to the CFO to say, okay, let's work out the numbers for this. And here's the challenge. The P&L, the forecast for the revenues and the different profitability margins, that's one side of the story, but everything requires capital, and capital will come from other people. So as you map out the next 5 years, because you should look out well beyond, your strategy is not going to stop at the budget cycle. So why should your financial plan stop at the budget, right? So you should be mapping out multiple years. And as you're thinking out, you're going to have to go through, critical capital planning assumptions. How am I going to get the cash to achieve what I want to achieve? I want to grow by so much. First of all, why do I want to grow by 20%? It's to target an exit. It's to target a certain valuation. It's to be able to acquire a competitor, and that's going to require capital. It's to be able to expand my production capacity. Whatever it is, I have big capital-driven objectives in mind, and those will need to be mapped out over a number of years. Some of that capital will come from me. They will be undistributed profits that I've accumulated in the business. They will be the cash that sits on my balance sheet at that point. But a lot of it will have to come from outside, and outside has requirements. PE has requirements, private equity. If you're in tech, VC has requirements. Definitely lenders have requirements. So as you're looking at the capital sources, you're going to have to make yourself picture perfect for that time into the future when you do go present yourself and you want to get favorable answers. And that's really where the key is. And I post on LinkedIn a lot, and I was just posting about the importance of not stopping at managing your operating cash flow, which is where a lot of the expertise in the finance space tends to cap. It's looking at the investing cash flows, looking at the financing cash flows, and really look out a number of years into the future and plan those like a puzzle so that the right capital source, the right investment that maximizes shareholder value creation, they're all in the right place at the right time. So the first thing to answer your question is misalignment between business strategy and financial strategy. And I hear this from people a lot. They talk about the business plan. Well, I've done a lot of business plans, and fundamentally, the biggest part of a business plan has to be capital allocation. And that's really the financing that's driving your entire business plan. You want to scale up operations, you want to scale up production, you want to scale up marketing. Everything you want to do requires capital. So planning that capital in tandem with the logistics of how you're going to do it is critical, and the timeliness of all of that. So that misalignment is the first thing. And the fact that CEOs don't, and I mean, there are a lot of programs out there, but a lot of them are very long and either very, very high level or very technical. So educating yourself as a CFO in terms of financial leadership, like I call it, financial intelligence, it's not necessarily easy, which is why I think my program delivers where others don't. At the end of the day, you can't teach a CEO finance the way you would a CFO. I speak to CFOs, I speak to CEOs, and I know how to tailor the conversations differently. So the second blind spot is
I just want to jump in there. I
education.
think part of where we've gone wrong is we listen to the investment bankers, funny enough, and they talk about EBITDA, right? And I wrote an article not that long ago about how Warren Buffett views EBITDA, and his answer is it's a bogus metric. You shouldn't even talk about EBITDA. The actual only number that matters is free cash flow, right? So you can imagine a business that makes $1 million of EBITDA, but it's got $1 million of capital requirements every year. Well, it actually made zero, right? And you got another business, maybe, a software business, which has got $1 million of profit. It has essentially no capital requirements. That's $1 million of real profit, minus cash I might need for growth, to your point. I think the gap I see with the CFOs is many of them are really not facile with the cash flow statements. So they're good with the P&L, they're good with the balance sheet, and yet what you're really talking about in terms of cash management, not only short-term, long-term, is the cash flow statement, the cash flow forecast. And they just don't think like that. And I don't know why, because it seems like one of the more important of the three, but that's my opinion. I mean,
Here's what I think, Jim. When you think about a CEO, they are invested. Most of the times, especially in your audience, they will still be either shareholders or maybe majority shareholders. Many times they are so significantly incentivized at the stock, at the ownership level, that they have a very long-term horizon in the way they approach business planning and business strategy. Now, take the CFO on the other hand. CFOs are very unlikely to be shareholders, meaningful shareholders, or incentivized in a meaningful way. So what happens is you end up with misaligned time frames, right? They're going to think for the next 12 months, for the next 24 months, they may not be there for the next 3 to 5 years. Meanwhile, the CEO's probably going to be there for more than 5 years. And so misaligned time frames, misaligned risk appetites. And this is a typical case of the principal agent problem. If, for anybody that's familiar with that, this is where you're effectively delegating decision-making authority to somebody that is in a position to abuse that voluntarily or involuntarily, because their objectives are fundamentally misaligned with yours. So as a CEO, you can't not educate yourself at the strategic financial intelligence level to understand whether or not the assumptions that are being brought to you from the CFO, to your point, are they driven to cut costs and produce a strong EBITDA in the short term? Or are they driven to maximize the value of the enterprise, in which the CFO probably participates none at all? So not incentivized to do that, but fundamentally as a CEO, that's what you want. You want to grow those free cash flows, because free cash flows are the biggest. Free cash flows and the risk profile of those cash flows are what drives the enterprise valuation. And that's what CEOs are ultimately all about, right?
Yeah. I'm a real fan of EVA, so economic value add, as an analysis. So for those that are not familiar with it, it's your entity is charged for your cost of capital effectively. And this is particularly true in a divisional operating structure where, cash is free. I can just call mom and dad and they'll send more money. But when you pay for your capital with an implicit interest rate, any project that you do has to beat that interest rate or you are destroying wealth. If you beat that interest rate with risk adjustment, to your point, you're making wealth be created. And I think this is something we're not educated well on as leaders, but that's like thinking like an owner, right? And that's how you can get your team to think like an owner when they are compensated on EVA, not short-term profit. Because they'll go, all right, great project, grows revenue, margins thin, but so what? And they go, ooh, wait a minute, the capital required to do that versus the returns are really bad. We shouldn't do this, and changes their thinking. So when you think about sort of project finance and returns on project, what is that the model you use, or use other models? How do you think about good project, bad project? How do you help people get to that point?
Well, I actually have an entire framework that I teach
Yep.
CEOs at the high level in my program. But back to free cash flows. Free
Yeah.
cash flows are a fundamental driver of valuation. But when you're planning your investments, they're not what you want to use. I call it the real free cash flow. You need
Hmm.
to look, free cash flows are effectively operating cash flows after investments, but you need
Hmm.
to first consider, have those investments been provisioned to, because you're planning your capital, you're looking ahead, right? So what level of investments do I actually need to make versus these are discretionary and I just included them in the plan? So the
Okay.
first thing is strip everything out and see, what do I need to invest in to maintain the productive capacity of my assets, right? So operating cash flow, and then I strip out any investment that I need to make
So this
to
is like
defend.
zero-based capital budgeting, essentially.
Exactly. And then I also need to subtract the amount of cash that I owe my lenders as a principal repayment, because people forget only interest is captured in operating cash flows, right?
Yep.
So you need to account for those principal repayments. And then you also need to account for any, I call them constructive obligations. So if you, for dividend payments, you may not have an obligation legally, but if you've been distributing dividends year after year, it's not like you can back out now and say, I'm going to take all that cash and do something, not before you check with them. So this is what I call real free cash flow. And at that point, you can look ahead and say, what are the strategic objectives? So coming back from SWOT, right? There, everybody is used to the SWOT concept, and not everybody is used to funneling a SWOT from Pestel and from Porter's 5 and from other strategic frameworks, and then from proper internal financial analysis and internal organizational assessments for the internal strengths and weaknesses. But assume you've got your SWOT done. At that point, you have a strategic tool. You need to turn that into a financial tool and get a financial SWOT in place so that you can take that and figure out what objectives make sense strategically that play on your strengths, that minimize or neutralize, weaknesses and threats, so that you can have a list of good investments that you want to allocate capital to. And that, coming back to your point, is where you want to understand, where should I allocate my capital, and how much additional capital can I attract to put any of these in place? So at that point, what we have is capital budgeting frameworks, of course, and you never want to use one. You want to use NPV, IRR, indexes, and obviously qualitative goes along with all of that. So never one framework, always a mix, and always add qualitative. So once you have those in place, that's where forecasting takes over, and it tells you, are you on track? And as you measure performance year after year after year, to your point, you need to be able to say, is my capital being deployed in a way that makes sense for the cost that I'm incurring to put it out there? And that's where EVA is so powerful. So from a compensation perspective on an annual basis, absolutely EVA is great. For underwriting, for putting the plan in place, there are other frameworks that are probably helpful.
Yep.
And I would start there.
Yeah. And I also think when you're trying to, for example, raise capital from more traditional sources, banking and an EVA analysis, is going to blow their hair back, because they're going to go, nobody thinks like this, that you are going to have to vastly exceed the cost of the capital we're providing you. You've got a plan to do that. That would give them great comfort, I think, in terms of lending money. VC's different. They're more about the exit strategy, but that's great. So when somebody's trying to hire a CFO, and as companies are growing, they sort of hire a controller, minimum viable capability, and then they get bigger and they go, okay, if we're really going to double this company, we need a different caliber of individual there. What would be your guidance to a CEO saying it's time to bring a CFO, a real CFO who can help me be forward-looking and strategic? What would be your guidance on trying to find and hire and be sure you got the right person? Maybe more importantly, so I don't, kiss five frogs to find one prince or princess. What advice do you give people when they're thinking about it's time to hire that big job?
It's a great question, and it's one that trumps a lot of companies. And just recently,
Yeah.
we were speaking with a number of companies that have actually had disappointing experiences hiring expensive CFOs that didn't really give them any benefit. So they ended
Yeah.
up downsizing and letting them go. So the challenge is, if you have so challenge number one, if you as a CEO don't understand what you need to get out of them, if you don't understand the value, and you have this very big sort of top of the mountain type perspective, they're just kind of come in and make it all, perfect. I think that's where the problems start. There's something called operating finance, and I have a nice
Yep.
pyramid on my on my website, there's something called operating finance and there's something called strategic finance. So at the operating finance level, you're going to find your controllership, which looks at compliance, day-to-day reporting and compliance with accounting principles, your year-end reporting, relationship with auditors, they're going to handle that. Then you have treasury, and treasury is going to look at your short-term capital planning, right? And then you're going to have FP&A, and FP&A stands for financial planning and analysis, and they're tasked with optimizing the costs, maximizing, improving revenues, making sure that from an analysis perspective, you've got the outcome that's going to make the plan the best there is. But they're not going to look out. They're not going to first have capital financing experience. They're not going to be M&A experts. They're not going to be able to help you manage your valuation and the valuation drivers. If you're targeting $100 million valuation in 3.5 years, because that's your exit plan, they're not going to help you there. If you're targeting a $15 million expansion plan, they're not going to help you there. So they will not speak the language of the outside world. They will speak the language, which is your lenders, your investors, your, anyone that you're trying to acquire or get acquired by. So fundamentally, that's your operating finance layer. And assuming you've got that figured out, and the challenge is, how do you find that strategic CFO that's going to be able to fill the rest of the responsibilities, everything I just listed and many more? So this is where you go and you search it, but you don't know what you're searching for. So if you have the framework I just gave you, at least you know what you don't want. You don't want an operating CFO at that point. And if you do, because you don't have operating finance figured out yet, then don't expect them to do strategic CFO work. So this is where it's a layered approach. And that's why we created Financiario, because Financiario effectively comes in and takes over that strategic layer of modeling. And it takes the intelligence and the knowledge of an M&A advisor, a banker, a corporate, a high stakes banker, and a number of other critical roles, so that the plan that you build is not a budget 12-month operating CFO style plan. It's a 5-year strategic, outside world focused, presentation ready, intelligence ready plan to make those right decisions over the next 5 years. So at this point, you get a strategic CFO, their capacity is 10x. They don't have to spend any of that time. All they need to massage is the assumptions. And they're the ones that are going to have those critical conversations with investors, with lenders. You maximize their output. You make them 10 times better and your investment in them. And if you bring in an operating CFO, your business is not going to struggle without that strategic layer either with what we do, because they're going to be able to manage that operating finance layer and manage all the operating functions. Meanwhile, the business is not going to get blindsided when the CEO says, okay, I'm ready. This is the year we finally put $15 million, to work. And the bank says, I'm sorry, based on your current risk profile, we can live with 11.
Got it. Yeah. Interesting. So I guess if I'm trying to hire a CFO and they talk about how quickly they close the books and how accurate the numbers were, you're like, that's not my person. Like, I need somebody who's a little more thoughtful about it.
That's a controller. That's a controller.
My point.
Yeah,
that's a controller.
Yeah, exactly.
Well, what about the nuances of dealing with private equity? We've got a number of people we work with that are private equity owned, and they've got, a stack of MBAs from Stanford, Harvard, wherever, are going to ask a billion questions. How do you advise CEOs and CFOs when they're dealing with private equity ownership and the information needs that they have, particularly, which are profound, right? It's every scenario you can imagine times 5, and you got to respond to it. How do you help them think about that and guide them?
Well, it's everything we've built for the needs of the outside world. So if you think about how stringent the due diligence and the ongoing monitoring from a PE firm is, it gives you a sense of what you should really be thinking about for your own business, even if you don't have them involved, because they're going to be in the best position to optimize what today might be not functioning very well in your operation. And the same with a lender. If they come asking questions that you do not have answers to, that's a huge red flag for you, because all that says is you have not thought about the critical, pieces that they have, and they're not in the business running the business for you. So you need to be in a position to, anticipate before outsiders need to know. You should need to know as a CEO the answer to all of those questions. So it's a really good mirror to put in front of you, even if you're not dealing with them. But if you are, to your point, it's a very big order, tall order on a CFO to show up prepared every single time.
Well, there's a Chinese expression. They say a fool can ask more questions than a wise man can answer. That's the problem, right? Like
Yes.
you can have a CFO that's wired tight. They know what they're doing. Trust me, some MBA will come up with a question that they never thought of before, and they'll look like, a fool because they go, well, you never thought about this. Well, yeah, because it's not important. Go try to convince them that, though.
Exactly. And that's where the perspective of an outsider is very, very different. And that's where strategic finance and operating finance, you brought up such a good point, Jim. Internally, when companies think about their performance, they consider strengths and weaknesses very different. They're very bullish on their forecast. Outside, they're going to say, well, you don't have a track record of executing at this level. So what makes you so confident? Internally, you have your hunches and your feelings, but outside, they want to see something else. So it's really, this is exactly what we built. So feel free to take a look at what we do at Financiario. This is exactly what we built. Infinite number of scenarios and answers to every single question. Actually, funny enough, one of the companies that we spoke to recently just said, my PE firm would love to have all this. This is exactly what we need.
That sounds like it. It's PE ownership's dream, yes. Right?
And for a good reason. Right?
Yeah. Awesome. Well, let's end it. Before we give people an opportunity to get a hold of you, what do you do for fun when you're not changing the world of finance?
I have a very big mission. To me, I'm only going to live for another, hopefully, number of decades, but the problems that I'm solving, I did not invent and I will not solve all of them, right? So I have a very big mission to impact at the CFO, strategic, operating finance, whatever it is, knowledge level, and I publish on LinkedIn a lot for that. And then at the CEO, executive financial intelligence level, and I want to coach and help as many CEOs as I can. Because beyond the business aspect of it, the impact is rooted in all of the issues that I've witnessed as a banker and all of the companies that I wasn't able to help. And I know that the opportunity, when we talk about economies, how, the small and medium size is the backbone. It's really critical to enable them with the right knowledge and the right systems and the right executive financial leadership to make those better decisions so that they can ultimately grow into those multi-million and multi-billion-dollar enterprises.
Nice. Yeah, it's funny. We have a very similar objective. Our objective is to positively impact 1 million lives through our education and working with CEOs. And we keep track of it, actually. And we're around between call 350,000 people that we impact on an annual basis.
That's amazing.
Yeah,
I have 370,000 followers on LinkedIn,
nice.
But my views for all the posts that I've posted have crossed 135 million.
Nice.
So I don't know what goal to set, but
there you go. I think we're going for $1 billion.
Let's go for $1 billion, Jim. I like
there you go. Well, this was fabulous. How would people get a hold of you if they want to dig in deeper with you or with your software products? What's the best way to get a hold of you?
Well, the best way is either through my website, Financiario, or oanalabes.com, OANALABES.com. And you can email me at hello@oanalabes.com.
Nice. We'll make sure we put that in the show notes. So
thank you.
Oana, thank you so much for coming on. We really appreciate the knowledge you shared. And I don't think we'll hit 1 billion on this podcast, but we'll move the number a little bit. So thank you for coming.
It was a pleasure. Thank you for having me, Jim.
Awesome. And for all of you who are listening, we'll see you next time on the CEO Project Podcast. Thanks for joining us. Thanks for listening to the CEO Project Podcast. We'll see you next time. Be sure to subscribe to get all the future episodes and check out our website, www.theceoproject.com.